Today we're going to talk about one of the best price action trading strategies for Forex trading. Stay tuned, traders. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. Today we're going to be going over again our simple method. It's price based, high of the day or low of the day, equity opening times, round numbers, double zeros and 50s, price action confirming our trade entries, asymmetrical risk reward targets, learning to take profits and cutting our losses, the importance of these two, not just lip service, but the importance of the critical nature of cutting your losses. That's what will allow you to be profitable over the long term and keeping your positive expectancy up above your loss ratio. Understanding all the manipulation tactics that occur in live time with the smart money, and then being able to execute over and over and over again, getting consistent, getting knowledgeable about identifying the price action patterns. But today specifically we're going to be talking about mastering the high and the low of the day and the critical nature of that. Now, one of the most important things that I keep pushing is that it's not about trying to get pips out of the market. We're talking about a trading approach that allows us to have a simple method where we can take risk on at one area with 1R, targeting maybe 1, 2, 3, 4, 5 or more sometimes of profit. This is why you can take a loss up here of 1R, and if you're targeting at least say 3R for your profit target, you can take a couple of losses and hit a trade, and you're getting 3 times that loss or 2 times that loss. That's what will ensure that you're able to not only stay psychologically focused, but process oriented and treat trading as a business. When we focus on the high and the low, you also have to realize, and we've talked about this in other videos, this is where the money is. The stops, the pending orders, the profit targets, the bulk of retail trading entries are up there. They get into these, their indicators drag them up into a trade, or by the time their indicators cross over, they're midway through the move. They get another swing confirming at the last leg before they're engulfed or reversed, and they're holding on to that all the way back down to where their stop is. Those trading strategies tend to work once or twice in a template where during the week the market makes an extended run. The problem is that when you hit every signal, you get chopped up outside of those signals, and that's what is frustrating for a lot of traders. A lot of the algorithmic trading is able to sustain hitting every order because they have a large pool of capital where they can execute multiple trades and have drawdowns through choppy markets. And when they're in long trending markets, they can pyramid into those trades as well. For a retail trader, that can be difficult to be hitting multiple trades, not only mechanically, but also financially and psychologically. It's hard for a lot of traders to take losses repeatedly and still execute on the same trade signals the next time it presents. But again, today we're going to be mainly focusing on the emphasis on the high and low. What's important to understand about all of this, and for all the people that have been emailing me and commenting, etc., I appreciate all the questions and feedback, and also you're starting to understand the simplicity of being able to duplicate this method, which shows up every single day, regardless if they throw 1,000 pip spike up here in the morning. Guess what they do later? They still make a high and they still make a low, and the market still gives us a bull hammer and goes up 200 pips before it gives us an engulfment pattern going the other way for a measured move down. Redraw your highs and lows. Don't get caught into the tricks that they do to confuse traders technically. Focus on the equity opening times, that 12 candle window, 4 candles before the open, 4 candles after. 90% of the time we're going to get a really good setup at the low or the high. But also, we talked yesterday about the rolling over time between New York and Asia. Stop hunt, peak formation, or consolidation. This morning we saw a fantastic setup on the pound yen, a stop hunt, then an engulfment at numbers. That market has moved over 300 pips with a 1-bar stop. So just something to consider, keeping it simple, because you can duplicate this every single day. We don't argue. We know there's a high and a low. And we talked about identifying key anchor points each day from previous sessions that you may be trading inside, and then identifying the 00 box that you're inside. Are you above 50, below 50? How is that market trading as you head into the market equity opening times? Round numbers, specifically 00s and 50s. And then the price action confirming this. So we've talked about engulfments. An engulfment is when a bear candle will completely envelop a bull candle, and vice versa going the other way. But we want to include that specifically with our high and our low. There is one other pattern that we haven't talked about just yet, but we're going to show some examples of today on the charts, and that's the 1, 2, 3. Whenever the market approaches a high in 3 bursts, the market, be prepared for that market to do one of usually 2 things: reverse immediately with an engulfment, or consolidate possibly with an inside bar or a doji and move sideways. When you get that sideways movement, if it doesn't reverse immediately, you have to be looking to see if that market is preparing to do a measured move. If it was going long, you might see a doji, a bull candle, then a bigger doji, a bull candle with a doji again, and then a bigger bull candle with a tail before moving strongly out of that consolidation. Whenever a market moves 50 pips and consolidates, you're looking for reversal with engulfments or pin hammer in the other direction at the high or the low of the day, or consolidation inside bars that could indicate that market is preparing to do a measured move. When we have a low in place, possibly it could be a pin bar, we could already have an engulfment, and the market returns down. If it returns down in 3 bursts, and again we get an inside bar or a consolidation, and it's at timings at the equity opening, could be at the New York Open, it could be at the London Open, it might even be in Asia. You may see another reversal or engulfment to move back in the other direction. But the concept I want you to think is that whenever you get 3 candles, 3 bull candles going up, or 3 bear candles, pardon my artwork, going down at a high or a low, that is most likely a stop hunt. If it's by itself moving up from a previous trade into a high, 1, 2, 3, that could also be a blow off. If we're at the high of the day and the market moves up 1, 2, 3 into a little bar, and we're 50, 100 pips up from where the market started, or 180R again, or down at the low of the day at 180R, that market could be preparing to be the final leg. And again, are we at numbers? So we'll look at some examples today, but again, we want to focus on the high and the low. Again, that's where we can target asymmetrical risk reward. That's where the bulk of retail orders are. That's where the institutions work. We want to focus around equity opens. Think about it. When the banks go to work in the different regions around the world, or the smart money, Asia, London, New York, that's when we want to go to work. In between, if you're caught inside chasing stuff in between, you have to, outside of these times, you have to be thinking, yes, there could be trades, but you could also be getting bottled up for when the market opens to hit stops on either side. Something to consider. Focus around the round numbers. We'll look at some candle patterns today as well, asymmetrical risk reward, and if you've been doing this now, you understand that there are behavior tactics that the smart money use to manipulate us in live time that's going to require you developing that performance skill. So it's one thing to have knowledge and know everything about the market, but it's another thing to be able to execute in live time and not get shaken out even when you're right of winning trades. The other component of that is then getting consistent at hitting those trades, repeating the process, knowing that you can execute, and then bumping up your size and being in increments that you're comfortable with in terms of your risk towards trading. So again, simple. Simple, simple, simple. You can reproduce this. Reproducible. That's the key. You can reproduce it and scale it up in size. That's what we want. We want to be able to target these same trade setups over and over and over again. They show up every single day. London, New York, and Asia. Scale them up. Repeat the process. Scale them up again. Monitor your performance in live time and just keep getting better. So let's take a look at some examples now.
Good day, traders. Stacey Burke from Stacey Burke Trading. Just continuing our discussion about the high and the low and candle patterns. But I also wanted to show a chart from yesterday on the pound New Zealand and why it's important, no matter what the market throws at us, 1,000 pip wick, that we redraw our highs and our lows as the market begins to stabilize over the course of the next 6 hours, 5 hours, whatever. This particular pattern, I want to show an example from back in February where we saw almost an identical situation, the only difference being that this one occurred at the low of the week. The market went up and gave a 200 pip spike, 150 pip spike in the Asian session. Similar to yesterday, obviously this was quite large, but we had spikes in all the pairs. But then the market consolidated, and then as we came towards the end of the Asia session into the Europe rollover, the market made a new peak, and then in the London Open rocketed up with a stop hunt to the high, and then an inside bar at numbers back down in 1, 2, 3, 4 bursts. And we talked about whenever you see candles go 1, 2, 3 to a high or to a low, this was a stop hunt on traders who were long off the 1, 2, 3 reversal. We then had a engulfment setup at the low of the day. Now, although this candle didn't completely engulf the bear candle, that momentum reversal is exactly the same style of trading pattern that you will see when they spread the market apart. The only difference being this time is that we're at the high of the week, and instead of them working the high first to bring traders down low to trap them, they've brought traders up high into the London Open, into the end of the London hour, to trap them up top before they shorted the market. And again, a 1, 2, 3 engulfment at the high, sideways, inside bar, reversal down. So again, they brought traders up long for the reversal at the high of the week. In the previous example, this wick was a snowplow or clearing out orders. Then they dragged traders up high thinking the market's going long. Technicals would have had this as a long trade, moving averages, before they reversed it to stop out all this trap volume, and then reversing to go back in the direction of the trend that there was intended. So again, whenever you see manipulation or widespread flash crash, whatever you want to call it, coronavirus, it doesn't matter. Go back to basics, redraw your box. The candles after the spike, those highs, those lows included, look for these engulfments at these extremes. This is at the end of Asia, heading into the Europe Open. At the Europe Open candle. This is at the London Open, beginning of London. And that market then moved down, did a measured move, went sideways to the low of the day. And at the New York Open, right here, 1, 2, 3, 1, 2, 3, engulfment pattern for a measured move down. So again, whenever you see 1, 2, 3, the market went through the low here and then consolidated. That's where traders would look for a measured move. When you see 1, 2, 3 exhaust at or near a high with an engulfment, that's a trade setup. That's what we look for. Engulfments, pin hammers at highs or lows. If we look at the pound yen this morning, we talked yesterday about the 12 candle rollover. in that window between New York and Asia. Traders who possibly were trading off that engulfment. We had a 1 push, 2 push, 3 pushes down, but in the rollover we see pins on the bottom, sideways, and then an engulfment candle at round numbers. Screenshot these candle setups, screenshot these chart patterns. You will see them over and over and over again. A 1 bar stop, whether you put your stop down here or under here, I consider this to be one candle. That market then moved up, took out the high, 1, 2, 3 to the high, and then 1, 2, 3 sideways inside bar for a retest and a new high. 1, 2, 3 doji, 1, 2, 3 sideways. This is information that you cannot get anywhere else. I want to show you this pattern. You will see this over and over again. Pay attention to this. The market is telling us where they're going to possibly head to next. When we see this, when we see this pattern, 1, 2, 3, sideways, inside bar, doji, doji, breakout, inside bar. The market moves strongly. Where is it going? Who's in profit? That's where they're going. 1, 2, 3, inside bar, double inside bar, 1, 2, 3, sideways, and possibly an engulfment now. And we'll watch how this market behaves in the next hour for evidence that this possibly could be putting peak formation in place for a retest on traders that are profitable. But again, this pattern, if we go back and look at the New Zealand pound last night, same pattern. Screenshot these patterns. You will see them over and over again. Whenever you see a doji at the bottom or the top, then an inside bull candle. Take again a look. Doji, inside bull candle. Another doji, and then a snowplow bull candle. If you're not sure what a snowplow is, it's a candle that puts a wick up and pulls back. Orders. Doji, snowplow. Open drive candle. Inside bar, open drive candle. Start paying attention to these patterns. When you get near highs and lows, 1, 2, 3, engulfment. These patterns are everywhere. So hopefully you got some value from today's video, traders. Master the high and the low. Focus on the equity opening times. Look for these engulfments. Look for round numbers and 50s. And then place your stop. 1 bar with an asymmetrical risk-reward target. Have a great trading day. We're going to have some big moves this week. Stick with the high and the low, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.